Howdy there, folks. Welcome into the reaction channel. Two videos to react to here today in this one. First one up here. The market is reacting badly to bad news. I have actually not seen this video yet, but I was like, let's hear what Josh Brown has to say here. I hope it's good, by the way, because it's like 40 degrees in this garage. I had to bring myself a hot cocoa out here, man. It's cold as mold. So let's hope that one's a good one. This one I actually did watch live when I watched Fast Money here today. I want to react to this one with you guys here today. This gentleman's talking about another 50% downside for stocks. And I thought, okay, that's an interesting take. Let's hear what he has to say. I want to react to that one in today's video. I appreciate everybody joining me. I appreciate everybody subscribe to the channel. 21,000, and I think we're over 21,800 subscribers now at this point in time. So I appreciate each and every one of you. If you ever want to say hello to me, by the way, say hello on Instagram. Financial Education Jeremy. Do not fall for all the fake accounts that impersonate me out there, because there are a whole lot of them. But follow the real deal Holyfield. I'll put that as a pinned comment. So if you want to say hello to me on Instagram, you can go ahead and do so. Yeah, that will be a pinned comment. Let's get into this.
Of Ritholtz Wealth Management, a CNBC contributor. It's good to have you back right here with me at Post 9.
Loving it.
Kind of a nasty day.
Yeah.
Out of steam, out of gas, pushed over the edge by some Fed hawks. All the above. What do you think?
I think it's okay. Listen, I think it's okay. We've had a really big run. So far, we're just digesting that run. We were on the half yesterday talking about, look, we know the data is going to get worse from here. It's going to deteriorate. That's what you had today. Retail sales fell 1.1% in December. Negative 1% was expected. Doesn't sound like much, but that is the biggest monthly decline for all of 2022. So we finished the year in much worse shape than we were for much of the year, at least on that measure. Retail sales have now fallen 3 out of 4 months, Scott.
3 out of 4 months, retail sales down. Keep in mind, those retail, this is very important for everybody watching this. When you see those retail sales numbers, they don't even adjust them for inflation. They don't even adjust them for inflation. So if you see a negative 1% number, but inflation is, let's say, hypothetically 8%, that's really like a 9% difference there, right? So that is just a little food for thought, something to keep in mind there.
Notable. The Empire Manufacturing Survey was another one that got people's attention. This was the 5th worst contraction ever since they've been keeping this data. It was the weakest since March of 2009, taking out the COVID.
This is the stuff I'm talking about that no one is paying attention to, in my opinion, right now, or very few are paying attention to this. I don't think like 98% of people are keeping even up to date with any of this going on right now. And I'm like, literally, like the economy is deteriorating in a massive, epic way right in front of our eyes, but I feel like most people just don't see it.
That really is a big asterisk. That's getting people's attention. That index is in contraction 5 out of the last 6 months.
You know when it will start to get people's attention? When this baby tanks in a massive way. I remember the great financial crisis, and that's when I was starting out the money journey, right? 2008 and 2009. And I don't remember hearing anything much about the economy or the stock market or things like that until about summer or fall of 2008. That's when all of a sudden I started hearing about it. I remember my mom used to watch the CBS Evening News. I think it had Katie Couric back then. Katie Couric, anybody remember Katie Couric? I believe she was the one that used to do the CBS Evening News back then, if I recall. And she would have it on, and they would be talking about the stock market and how much the market fell and how bad the economy is getting and how many foreclosures are starting to happen and those sorts of things, right? And it's funny, it takes mainstream media. It really takes them to really flood it out to the masses until the stock market starts to get hit in a massive way. That's when all of a sudden you start to hear about all this news. So until this baby really starts to tank in a major way, the masses won't really pick up on this. The mainstream media won't really run with this story.
That print was twice as bad as what people expected. And so what I would say is, look at the 10-year, look at bond prices screaming, Look at yields melting away. The market is now doing something very interesting. It's actually reacting badly to bad news. That tells you fear of the Fed is not the story this year. The story is, what have they done? Have they gone too far? Well, are they going to recognize it? That is the new paradigm we find ourselves in here in 2024.
Yeah, and the Fed's not even close to being done yet, right? I mean, everybody's expecting the Fed to maybe turn 2024. And I'm thinking the market might try to force their hand this summer. That's just my opinion.
of the Fed, just in a different way. It's of over-tightening.
Fear of what the Fed has already done. It's retroactive.
Not only that, but what they're still pledging to do. You hear Bullard today?
Yeah.
Bullard, 5.25 to 5.5, go 50 next meeting. Now, he doesn't have a vote, but nonetheless, his words matter, right?
50 next meeting. Let me tell you guys this, okay? I think this is very important for everybody watching this right now, because I don't know if you guys know the expectations out there. But and if you watch my videos on the main channel, you know about this because I spoke about this earlier today. Wall Street is expecting a 25%, or excuse me, a 25 basis point move, okay, 0.25% essentially, in terms of Fed raising the rate. Over 94% of folks expect that. So when we hear Bullard talk about 50 basis points, if that were to happen, I mean, you're talking about the next day, maybe market's down 3, 4, 5%. Of course, some of this stuff might be leaked, so maybe the market downtrends way ahead of time. But that's just something to keep in mind here. When you hear folks like Bullard and others talking about potentially 50 basis points for this next, Wall Street's not expecting that. They're expecting 25 basis points.
This is like, we're going, and we're going to stay there, and we're going to go more than you think.
Because you know why? Because you can't undo everything that you've already done. You can't allow a 10% S&P rally to reignite manufacturing and retail sales and housing. Like, you really want to avoid having that outcome. And so what do? Well, you're not going to do 50 basis point rate hikes every month anymore. So the other tool you have is to just tamp down people's enthusiasm, make sure everyone knows.
Or maybe you do. Maybe you do. That's a problem. No one's expecting that, man. That's the thing that scares me about this whole situation. No one's expecting that. And it's like, maybe they do. Like who's to say they're only doing 25 basis points? Like, you know what I mean?
You're going to stay.
If anything, the Fed's been much more aggressive than I think everybody on Wall Street ever anticipated. Most of Wall Street expected Fed funds rate by the end of this year to be at, last year, now we're in 2023, in 2022, they expected Fed funds rate to be anywhere between 0.75 and 1.5. We ended at 4 plus. So who's to say we can't be wrong some more?
And keep the CFOs on track to continue firing people. I hate to say it that crassly. I hate to be the person that says it out loud. That is literally the thing that the Fed needs to continue in order for that 3.5% headline unemployment rate to decline. That is the only way they can declare victory. You cannot declare victory against inflation with the labor market as tight as it still is, despite the fact that we're hearing about big companies doing big layoffs. It just isn't enough yet. And so you're going to continue to hear the hawkishness.
What do you think the Fed thinks about this move we've had to start the year in the stock market? Bitcoin up 20% in a week, ARK stocks. It's kind of the trash is this, few weeks worth of treasure, so to speak. What do you make of that? What do you think they think of that?
Well, I think the Fed would not, other than Kashkari, would not publicly comment on it or offer any kind of an opinion. But I would tell you, it's not what they're looking for. It would not. Look, I don't understand this whole mentality. We talked about it on the show. Like, yields are backing off. Let's pivot back to buying garbage on the NASDAQ. Like, I don't subscribe to that being the right thing to do right now. I said yesterday, stick with what's working. Dividend aristocrats, high cash flow, high quality. Even if you don't outperform over any arbitrary period of time, you're not going to look like a fool that bought the top once again. I also don't like the VIX as a teenager. I think it's a mistake for us to get more bullish on a day like yesterday. You open up, you hit.
He basically, if you're wondering what it's talking about, teenager VIX, basically he's talking about like 19 and below, essentially. And recently, the VIX has been under 20, which is one of those things like I think everybody's expecting the VIX at some point to spike in a pretty massive way in the final stage of this kind of market meltdown.
Like 18 and change, 19. That is not where risk should be priced right now. So I think today just reverses a little bit of that. I'm happy to have been slightly ahead of the curve. The rest of this week might end up looking like today. I don't think it's the end of the world. What we're really doing is retracing a lot of the gains that we've gotten since Jan 1. It's okay.
Yeah, I agree. It's okay. It's normal. Let it happen, man. We got to hit this Dow down, S&P as well. But specifically, we got to get this Dow down another 5,000, 8,000 points, in my opinion. So, a bit to go in terms of the Dow, in my opinion. All right, next video up here, the most controversial one. This gentleman calling for 50% decline.
Bernstein advisor. Stan, great to see you in person.
Happy New Year, guys.
In terms of, we were just talking about, what the markets believe in terms of not believing the Fed, not believing the higher for longer. Who's going to win? Because it feels like, Fed officials want to come out and say, this is happening, this is happening, this is happening. And the market's not pricing that in.
Yeah, I think it's been a really confusing period for markets. I mean, at times, you look at the last couple of months, you've got this massive cyclical rally, spreads have come in. So off to the races, right? Growth, we're probably going to have a soft landing. But at the same time, there's all these concerns about a recession. And, I don't know what the market's really trying to price in. And I think at the end of the day, I think if today was really a bad news is bad news market, I think that's really healthy. I don't know if that's the case. As we said, the initial reaction was positive, and then there was some Fed speak to change the tone. If bad news is bad news, I think that's the right thing, because the reality is, when markets are rallying off of bad news, that's a myopic view of the focus on the Fed. But that's the Fed is a lagging indicator reacting to lagging indicators. The reality is, I can tell you what's going to happen with the Fed, inflation, growth in earnings, and rates. If you tell based on growth, growth is going to be the thing that drives everything this year. That's very different than last year when it was the inflation and when it was the Fed. I think growth is heading lower. I think that's going to not be perceived positive for markets. So at the end of the
growth is heading lower. This is a part that I almost feel like I'm the biggest bear out there, man. No, just to be quite honest, because I hear these folks talking about growth going lower, and I'm like, I think we're going to shrink. You know what I mean? I'm not talking about like we're going to have slight growth. I'm thinking about shrinking. And that's the issue I see with Wall Street, is they're still expecting growth in earnings, growth overall. Even this gentleman who's talking pretty darn bearishly, he's still talking about growth. And I'm thinking shrink. And that's kind of the scary thing that I'm a little concerned with.
Bad news is bad news.
Dan, you've been consistent with a lot of this view, and I it's been right. I look at your notes and I see tech could be down another 50%, 50, not 15, not, that's it.
Wow. Okay. Before we get into his number, what do I think about the 50% number? I think it's easy to throw out extremely bearish calls right now. Say stocks are going to go down 50%, this or that. No different than when you're in a raging bull market. It's very easy to throw out any price on any stock, right? And it consistently happens. And so you got to understand, it works both ways. This game works both ways. That's just the way it is, right? This drop in the market really started in February of 2021, right? With the Cathie Wood, the ARK stocks, the SPACs, the speculative stocks, all of those. And when you've been in a vicious downdraft for that long, almost 2 years coming up on from the start of this whole show, you're going to get, by the end of it, you're going to get some pretty outlandish calls.
Extraordinary. And I realize there are many different parts of tech. There's the internet, there's certainly there's cloud, there's software, there's data. Try to define that a little bit more.
Yeah, I think broadly tech, let's just call it NASDAQ or just anything having to do with tech. If you look at the sectors, the three sectors that have heavy exposure to tech are communication services, information technology, and consumer discretionary. Those three sectors, I think, are heavy risk. We've only come down from like half of the market cap to like 43%. There's definitely a lot more room. If you think about it, bubbles, which I think it was a bubble, take time. It takes time for people to just anything having to do with tech. If you look at the sectors, the three sectors that have heavy exposure to tech are communication services, information technology, and consumer discretionary. Those three sectors, I think, are heavy risk. We've only come down from like half of the market cap to like 43%. There's definitely a lot more room. If you think about it, bubbles, which I think it was a bubble, take time. It takes time for people to give up on their...
So this is a market starting, but so you're talking about the structure of the market. You're saying it was 50%. It's come down to only 43% of the market cap of the S&P. And that's just not the right number.
I think there's further downside because people haven't given up. If you look at the biggest holdings in people's portfolios, that's still where they are. If you look at the most expensive part of the market, that's where they are. Look just in the sheer number of products and ETFs out there, that's where they are. That's where the focus is. And I think it takes time for people, for that mentality to change. If you go back to the tech bubble, you had 16 different...
Wait, before he goes any further there, because I think he's going to make more interesting points here. I think people have given up on a lot of stocks. I don't think they've given up on the market. And I think that's more what he's talking about. In order to give up on the market, you've got to break people completely. And I think that's what Wall Street will do by the end of this. So break people completely. How you break the last group, break the S&P 500 and break the Dow 30. You break those and you break everybody. There's certain individuals like myself and many of you guys watching this that we're unbreakable, right? Like they can't shake us out. It doesn't matter what happens. The market could go to, I don't know, 1 point, and we'll still be in it, right? That's just our mentality. But we're an extremely select few. Most people, you can break them. Most people have already been broken in this market. And that's why they shook out of all those stocks. But how you break the last group and make everybody feel like the whole stock market's a scam, how you can get that to happen, very similar to 08, 09, drop the major indexes, the S&P 500 and the Dow 30, and you will break people and you will end people. And that will be the moment where people say, screw the stock market completely at that point in time, right? And that's when you get that final flush down of the market. And then you go on a 5-10 year bull cycle that most people don't even get to participate in, unfortunately. This is part of the process. It always happens this way. It's the way it happens, man. And it's just like these cycles come every 5, 10, 15 years. And it's what happens, right? And so a lot of folks got shaken out, a retail side, but you still got the index fund crowd there. You still got the large cap folks there that are still kind of feeling a little scared, but okay, because they haven't been nailed yet. Once those folks really get hit, that's when you get that final stage. That's when you get that final stage of capitulation in the market, nonetheless.
Out there, that's where they are. I mean, that's where the focus is, and I think it takes time for people, for that mentality to change. If you go back to the tech bubble, you had 16 different bear market rallies over that 2.5 year period. We've had 3 double-digit rallies in the NASDAQ over this time. So I think, again, there's going to be rallies, but I think ultimately there's a lot more pain because bubbles don't deflate overnight.
Mm-hmm. A lot of people make a lot about fund flows and where institutional investors are, and cash levels are still very high. And one argument would be, well, there's a lot of dry powder. That dry powder, though, can go many different places, not into U.S. equities. So what do you think happens to that dry powder? And why might the bull case, traditional bull case, that money will go back into U.S. equities? Why can that be wrong this time around?
Well, if you actually go look at cash levels in cycles, you actually see cash levels consistently pick up into and grow into the entire bear market. So I don't think there's anything surprising about high cash levels. And I think where could it go? Well, I think flows follow performance. That's why I don't tend to look at flows week to week or month to month. And if you do want to look at flows, what was the sector with the highest inflows last year? Well, technology. So that should be worried of itself. I think that you're going to see flows. You've seen flows follow markets. So you've seen big outflows after markets have fallen. You've seen inflows because we've had a rally. I think ultimately it's going to take years for the performance to prove where the flows will ultimately go. I think the leadership in the next 10 years is going to look almost a mirror image of what we saw over the last 12 years. And so, once you start to see that 2 years later, 3 years later, then you'll start to see the big flows into those areas.
Interesting. And one of the interesting things and one of the tough things about a recessionary environment, right, is a lot of things get heavily discounted across the board, right? So the options for your money is just more. And so folks with money have to say, okay, do I want to put my money in a stock or the stock market in general? Do I want to go buy a house that's now 20%, 30%, 40% less than what it was? Do I want to go buy a car that's, all of a sudden $20,000, $30,000, $40,000 lower than it was previously? And so folks with money, and obviously you have bonds that are out there. You have even put money in a savings account now because you're actually getting decent returns on that, and CD accounts. So that's the tough part, is all of a sudden you have more things competing for your money. Also for the folks that like crypto, let's say Bitcoin's all of a sudden at 10,000, 12,000. You think that's not going to attract some money? People saying, gosh, man, Bitcoin, they're thinking about when it's potentially 100,000 someday, right? Or thinking about the day of maybe Bitcoin's $1 million, right? And they see it at 10K and they're like, oh man, maybe I'll put some money there. That's the toughest thing about an environment like that. So anyways, hope you guys enjoyed today's video. As always, I appreciate every single person that's subscribed to the channel. If you're looking to join us in my private stock group, the private wealth group, check out the description area. There'll be an application down there if you're looking to fill that out, if you want to take investing much more serious than you have in the past. And once again, if you just want to say hello to me on Instagram, do so. That'll be a pinned comment. Appreciate you. Much love and peace.